This is David Morgan of themorganreport.com, and I am doing a presentation for Metals and Justice Forum. I want to thank Matt Bennett and all involved with the MIF for inviting me back. Well, if I sound a little agitated and a little more amped up than usual, I am, and there is a reason for this. For everyone that attends the MIF and conferences that are similar, we have been basically, I'll speak for myself, I have been on a crusade for a very long time to bring to the fore the problems in the financial monetary system. And we're there. So it's not a entertainment vehicle anymore. It's not a what if or when, it's now. And I want to start off this first slide and point out the headline here, which we all can read together. Evergrande's plunge wipes out $250 million, which, by the way, off of BlackRock and Vanguard Holdings. Now, according to this article, both BlackRock and Vanguard are the largest shareholders in Evergrande and have posted hundreds of millions of dollars of paper losses following a more than 80% share price drop in the troubled Chinese property developer. So I'll admit I've been a bit wishy-washy when this news first came out on Evergrande, that I thought it wasn't that bad, or maybe it was. Right now, it's unfolding before our eyes. And the point to note is not only the massive loss, but that both BlackRock and Vanguard are at the top tier. These two entities hold a huge amount of the financial sector in the United States stock market. They are paramount, both of them, as far as what they have. So I can't read the whole article because I'm not a member of the financial news here. The headline is enough. I think it's sufficient for you to understand that we are in a collapse. We are in an environment that's changing rapidly, and you can only do what you can do. Financially, as I've said for years, precious metals, you don't have to overdo it. You need some savings and real money. As far as the way to get leverage are in the companies, and right now is probably one of the best times I've seen in my decades in this business, which means that we are so undervalued on the resource sector, the precious metals miners and lithium, cobalt, you name it, copper, relative to the overvaluation, the S&P 500, that now would be a great time if you have holdings in the stock market itself to move into this sector or go overweight into the resource sector. So next up is an article that I wrote recently, and this is the real price of silver, $2,000 an ounce. And this, of course, is considered to be clickbait, and I will say, yeah, it probably is clickbait. But the point I want to make in this article, and I won't read the whole thing, but I'll just look at it occasionally to jog my memory, since I gave the speech at the Silver Symposium about a month ago. And I talked about the fact that, first of all, almost all commodities, with the exception of silver, are above their 1980 highs in price. But silver is the one laggard to the whole sector in the commodity space. And I talked about, what is the silver market? And as you all know, I talk about it being nothing more than a derivatives market. Really, the true silver market is it used to be an open outcry system where guys yelled at each other with hand signals and they settled, second by second, different lots of silver buying and so on back and forth. It's almost all electronic now. There's very little open outcry yelling back and forth. There's some, but most of it's done electronically. Regardless of how it's accomplished, what you're buying is you're buying a piece of paper, and a piece of paper says that you have the ability to buy silver in the future at a given price or sell silver in the future at a given price. That's what that market is. The physical market is a separate entity. The separate entity, the physical market, is really not going through the COMEX much at all. Only about 1% of the futures markets in all commodities, meaning oats, the grains, soybean oil, cocoa, cotton, or whatever, settled outside of the futures exchanges. They set the price, but when you're moving cotton, you go from a cotton dealer to, let's say, a 3M manufacturing company, and they ship the cotton there. I don't want to go too far off track. So here we go. I talked about how the technology has changed and how much silver is used in technology. It's gone from 35% of the market 2 decades ago to over 50% of the market now. And we've increased our amount of silver mined by about 300 million ounces, from 550 to about 850 in that time frame. So that's really something to be cognizant of. And based on my interview I did for our mastermind clients recently, about 3 months ago, Matt Watson, who does independent analysis of all the metals, did one on silver. We had him on, and he projects that by 2030, so 9 short years away, that the industrial component of silver will be 80% of the market. So we go on, or I go on to say that we had a very, very strong market in silver in 2020 as far as the amount of investment demand. 350 million ounces or 320 million ounces were bought by institutions through the ETFs, and roughly 200 million ounces were bought in the retail market for a grand total of about 520 million ounces. That is better than half of the silver market. We've never had that kind of physical offtake in the silver market ever that I'm aware of. Even in the Hunt brothers, it didn't comprise of over 50% of the market, to my recollection. So that brought the silver price out of that 8-year low and up into the 20s, and we've been as high as 30 and off, and we're backing out today as I'm doing this update, or this presentation rather. We're at $25 silver. So I talk about the petrodollar and how that all came about. And what I really get to is talking about how silver is valued. And when silver is valued as money, it is always valued very close to the ratio, or the natural ratio, of gold and silver. For those that don't know, the natural ratio is how silver and gold occur in the Earth's crust. There's roughly 12 times more silver than there is gold in the Earth's crust in the 13th century. And as of late, it's down to about 9 to 1. So a lot of silver is mined at the surface, and it is easily obtained. And those days are long gone. The old expression, the low-lying fruit, has been taken. And now it's more and more difficult, just like in the gold industry or copper or any of the miners, it's more difficult to get product because the easy stuff is gone. Now, on the monetary front, for the last 4,500 years, we've never seen a gold-silver ratio above 20. It's only been in the last 120 years where you have seen this ratio go above 20. And the reason for that is silver was not considered money and officially demonetized in 1873. And in 1873, it was called the crime of 1873, silver was taken out as officially money and gold only. We went to this gold only situation. Now, when that happened, we started to get these big gold silver ratios up in like 100 to 1, 125 to 1, March of 2020. And now, of course, here we are at near the end of 2021, the ratio is around 75. When silver is money, and remember, we were actually on a silver standard in the world for a long time, and it worked very well, actually. At that time, the value of silver was valued properly, where there was enough silver in circulation for everybody to have an economy and use a monetary instrument known as silver that satisfied settlement for everybody involved. However, I did in the speech a quick look on why silver is not money. And I used the idea that in recent times, going back to my father, actually, or my grandfather, $1 of silver a day was a good size wage for the average person. And as you know, $1 in weight is actually about 3/4 of a troy ounce, but we could call it a troy ounce. So I looked at the statistics from 2019. I found that there's 157 million people, 157 million people in the workforce in the United States. The average workday is 8.8 hours. And the average wage, which surprised me, is about $28 an hour. So that's roughly the price of an ounce of silver in U.S. terms. I use the 8 hours instead of 8.8. I use 150 million people rather than 157. You do that quick arithmetic and you come out with 1.2 billion ounces would be gobbled up if everybody was paid in silver. So in other words, if you paid in silver, or silver was money, and you had to settle the wage rate for all workers in the United States for 1 day, there would not be enough silver. So what that implies, and I really didn't go into this in my speech at the Silver Symposium, I just kind of left it open for people to kind of, mull it over in their minds, but I will move on and you can rethink it. But my thought is, obviously it's not valued correctly to be money. If it was valued correctly to be money, then you would have to have a huge multiple above $25 an ounce for it to be equivalent to a day's wage. So I took that thought and I moved on from there. I said, well, look, if you go back to the early days, go back into the 1940s, 30s, 40s, 50s, then an ounce or 3/4 of an ounce, $1, was worth a day's wage. So what's the day's wage? Well, you can play around with those numbers all you want, but roughly that's about $200 a day. Or if you take 28 times 8, you're going to come out a little higher, but I'm just going to use the number 200. So that would mean that 3/4 of an ounce would be $200 US in equivalent terms. And then what I did was I went back in time. Now, this has been done by others, not just myself, but I thought it was interesting because in a strong economy, everything works well. And Rome is a very good example of a strong economy until they started to debase the currency. Rome was basically run on a silver standard. Yes, there was gold, but it's basically a silver standard that ran the economic engine of the Roman Empire. And of course, they started to debase the silver coinage over time. And I think most of you know the end of the story. But at the time, a Roman soldier earned 1/10 of an ounce of silver. So I said, well, if today's weight was $200 for $1 for an ounce equivalent of silver, you would see it at 1/10 that amount or 10 times that amount. So 200 obviously times 10, we can all do that arithmetic on our head, is 2,000 an ounce. So that would be the equivalent of what it was worth back in the Roman Empire in today's venue. So you could think of the reciprocal. You could think of, well, if you were on a silver standard in the world, 1/10 of an ounce would represent a day's labor. So let's just move it up to an ounce, make it easy. So if we go to an ounce and you want to save a month's worth of labor, you would save 30 ounces. If you wanted to save 2 months of labor, 60 ounces, or 3 months, it would be 90 ounces. And that's why when people ask me, well, how much silver should I have? There is no right answer. It's dependent on your belief system. It's dependent on what you think is important. And it's your idea of, how much metal, real metal you want to feel secure and that type of thing. So I go to the high price. In other words, I think silver is still going to go much, much higher in paper equivalent. Will it go to 200? I don't know. Will it go to 2,000? I really doubt it. But I have said in the past, very early on, that I thought it would make it to $100 an ounce. So if I go ahead and round that up to 200 for this discussion, to have 3 months worth of savings would only be a 100-ounce bar. And a 100-ounce bar is what, $2,500 today, plus commissions, say $3,000. And it could be, in fact, I think it would be, but I don't know. I don't know the future, equivalent to 3 months worth of savings. And that would probably be sufficient. So if you take that thought and you move on to how scarce silver is relative to the per capita base, meaning, people, the amount of people in a given sector, I played with that. In one of the most popular videos I've ever done, Myths in the Silver Market, I explained that all of these coin dealers that I'm so familiar with, and many of you that delve into the physical side of these precious metals know that most dealers and advocates will say everyone should own a little, meaning that everyone should own a little silver and gold. And I agree with that. I think everyone that's an investor or has savings, you don't even have to be an investor per se. You just have to, anyone that has a bank account and has savings, excuse me, should have savings in real money, some savings in real money. And if that were true, if you did it in the United States and everyone owned 2 ounces, that's 2 ounces times a population of about 350 million people, comes out about 700 million ounces, which is roughly equivalent to the total silver market. Total silver market's 850. So you go to 3 ounces. You could say 3 ounces times 300 million, come out with 900 million ounces, which is a little more than the annual silver supply. The point being that only 5% of the world's population are U.S. citizens. So what do the other 95% have? There used to be a chart in the CPM yearbook, silver yearbook, and it showed the amount of silver used on a per capita basis in North America. And it was very useful to me or my thinking because it showed that, and Jeff hasn't put that chart in a long time, but it showed at the time, and the best of my recollection, it was about 1/10 of an ounce per person, per capita, means per person, in North America per year. And that makes sense to me if you look at, your flat screen TV, your cell phone, your laptop, what's in your car, whatever you added during that year. You might have added a new DVD player or whatever. Anyway, the point being that 1/10 of an ounce per person. And I just explained that it'd be really hard for people to save 3 ounces per person. There's just so few people that are invested in the silver market. It's really, really pathetic. The gold situation is a little bit different, very underinvested. About 1% of all financial assets are in the gold market, but 0.02% of the financial assets are in the silver market. So it won't take much of a move into gold, spill over into silver to see the silver price go explosively higher. And unfortunately, but I've said it in the past and I'll say it now, I'm afraid it's going to be fear-driven. I'm afraid that when people are afraid, they're going to look for something of great stability. And nothing has more stability in the monetary system than physical metal, just the way it is. Before that happens, there will be a run by almost everyone that is worried into physical cash. They will look for Canadian dollar, the Aussie dollar, the US dollar, the euro, whatever. They'll look for notes. They'll look for paper notes. And those will work for a while. But once this situation I started this presentation with the Evergrande situation, and you've got BlackRock and Vanguard going down, you're going to see more and more trouble. And the last thing I want to say is for the crypto people out there, which I am affiliated with the Lode project. It's ag.lode, lode.one. You can look it up. I am concerned that some of Tether's investments are associated with Evergrande. And if that's true, and I believe it is, then we could see a very big disruption in the crypto space because Tether is basically the pinnacle of how the whole system works. Without Tether and the stable coin, you have a system that is very, very fragile. So if you are invested in doing well in that space, I would have a tight stop or maybe sell off some, take some partial profits, maybe get your original capital back or maybe a little more depending on your exact situation. And I'll finish with this. There's a few seconds left. But remember, there's no fever like gold fever. None. When there's a financial panic through all of history, all of recorded history, on the monetary side, you see nothing like a run to gold. And a run to gold is something to behold. But silver, in today's high technology sector, in our world that depends so much on communications, silver will actually be the biggest winner. I still hold that view. I hope that everyone has a great holiday season coming up through the rest of the year. And let's make 2022 the year to shine in the precious metals. This is David Morgan of themorganreport.com.